The market just got a bold new forecast, and it's coming from one of Wall Street's most accurate voices, Tom Lee. He says the S&P 500 could soar to 7,500 by the end of this year. That's nearly a 10% jump from where we stand right now. But here's the real question. Is this a signal to buy before it's too late? Or the setup for the next painful correction? Welcome to Money Studio, where we decode what's really driving the markets, so you can make smarter, calmer, and more profitable moves. Before we start, subscribe, like, and turn on the bell, so you never miss the insights that move your money. Now, let's break this down. Tom Lee has been surprisingly accurate over the past few years, from predicting post-COVID rebounds to correctly spotting early disinflation trends. And now, he's calling for another year-end surge. According to his interview on CNBC, he expects the S&P to climb from 6,800 to as high as 7,500s, driven by what he calls a performance chase. That phrase sounds simple, but it might explain everything happening in the market right now. Let's unpack it. A performance chase happens when big institutional investors, mutual funds, pension managers, hedge funds, are underperforming the benchmark. By the end of the year, they're under pressure to catch up. If the market's been rallying and they're left behind, they have no choice but to start buying, even if prices already look expensive. This creates a sudden, powerful wave of new demand, not because of fundamentals, but because of career risk and FOMO at the professional level. Right now, over 80% of fund managers are lagging behind their benchmark returns. That's the kind of setup that can turn hesitation into a buying stampede. And that, Tom Lee says, could push the S&P towards 7,500 before the year ends. But not everyone's convinced. The same conditions that fuel rallies also plant the seeds of bubbles. Let's look at the checklist. Out of 8 classic warning signs of a market bubble, 5 are flashing red right now. We've got high valuations, rapid price increases, narrow market breadth driven almost entirely by AI and tech, low-quality companies catching speculative money, and a growing belief that old rules no longer matter. Sound familiar? It should. These are the same psychological ingredients that inflated the dot-com bubble. What we don't have yet is a flood of new IPOs, an extreme credit expansion, or full-blown euphoria among professionals. In other words, this isn't 1999 all over again, but it's not 2010 either. We're somewhere in between, and that's where markets get dangerous. So, if Tom Lee is right and we get a year-end rally, what happens after that? Well, that depends on what investors do with it. There's roughly $7 trillion in cash still sitting on the sidelines. If that money starts to chase returns, we could see a blow-off top before the next reset. But if the rally fades without broad earnings growth, valuations will have to adjust downward, and fast. That's why, even if the market climbs, you can't just follow the crowd blindly. The smarter play is positioning, not prediction. Let's talk strategy. Rule number 1, stay invested. Trying to time the top doesn't work. History proves it. If you miss just the 10 best days in the stock market, over the past 20 years, your total return was cut in half. That's why dollar-cost averaging, buying consistently through every season, beats market timing almost every time. Rule number 2, diversify by design. Don't let your portfolio become a one-theme bet. Tech and AI may be driving headlines, but resilience comes from balance. Hold broad index funds for core growth. Keep bonds for stability. Add gold and hard assets as insurance. Own income-producing real estate where it fits your plan. And if you like crypto, fine, but size it according to your true risk tolerance, not your excitement. Breadth beats bravado, always. Rule number 3, build your income engine. Your cash flow funds your future wealth. When markets wobble, it's your income that keeps you investing. A raise, a side hustle, or an upgraded skill is the most underappreciated asset you own. Markets reward persistence more than prediction. Now, let's address the elephant in the room, timing the crash. Everyone wants to call the top. Nobody gets it right. Alan Greenspan famously warned about irrational exuberance. When the S&P was at 750, it then doubled before actually crashing. Markets can stay irrational much longer than investors can stay solvent. So the goal isn't guessing when it ends. It's surviving long enough to benefit from what comes next. If you keep investing automatically, stay diversified, and avoid emotional decisions, you'll turn volatility into opportunity, while everyone else panics. That's how long-term wealth is built. Let's zoom out for perspective. Over the past century, 54% of days in the market have been positive. 75% of years ended higher. 90% of decades delivered gains. And there has never been a losing 20-year period in U.S. stocks. Those numbers tell the truth. Time in the market beats timing the market every single time. So whether Tom Lee's call for 7,500 comes true or not, the playbook doesn't change. Invest automatically. Diversify wisely. Strengthen your income. And let time do its compounding magic. You can't control predictions, but you can control your process. That's what separates wealth builders from gamblers. This is Money Studio. Subscribe, like, and turn on the bell. For more daily insights on money habits, investing, stock market, economy explained, and global markets and trends,